Now, welcome back, ladies and gentlemen, to the Academy Financial Trading's Foundation Trading and Investment Program. And my name is Alex Lynham. Very brief lesson today, bonus lesson we'll call it, 5 tips about leverage and margin. Now, guys, I know we covered this on lesson 2, but the whole idea of these two, which are inextricably linked, it is certainly important enough to go into in a little bit more detail just to make sure we are all on this same page. So, guys, the textbook definition of leverage is having the ability to control a large amount of money using very little or even none of your own money, and you're essentially in effect borrowing the rest. In layman's terms, guys, or the plain definition we'll call it for leverage is being able to control a large amount of cash by borrowing most of it and only covering a little of it with your bankroll. So let's say in effect if you put down $1,000, that would be considered margin. If your broker was offering leverage of 100 to 1, that means you could then control over $100,000, or you could call it a standard lot size, okay? So guys, we all know why the brokers offer leverage, because without it, simply it'd be too prohibitive to trade, meaning that nobody would trade. But the question is, what is the correct amount to use? Remember, there's a relationship between leverage and its impact on your trading account. Meaning the greater the amount of effective leverage used in your account, the greater the swings. So the bigger the moves, whether it be up or down in your account equity. And then the smaller the amount of leverage used, the smaller the swings in your account equity. So remember, guys, as part of our course, we frequently talk about using less than 10 times effective leverage. You have to be very, very careful. Just because you can use it doesn't mean you just go out and start risking it all away. So we've already covered why leverage is there. Remember, without it, unleveraged cost per transaction are prohibitive unless trading off a large account size. So basically, nobody would trade. If you wanted to trade multiple lots of gold, each one being $100,000, I can't speak for the rest of you guys, but you would need quite a large bank account and quite a large account size in order to trade multiple lots of gold without it. And then let's not forget about the trade size. Remember, we did an example on lesson 2, where if you had a nice healthy $5,000 in your account, now that's nothing to turn your nose up, but that would only buy you 4.5 ounces of gold. So your returns would simply be too small. A bank account would do essentially the same thing for you, as someone pointed out on lesson 2. But remember, you would have to risk the whole 5,000 just to make anyway decent profit. So it's just too risky. Why would you do it? And then, of course, you have diversification, guys. Without leverage, most traders would not be able to access a lot of these instruments. So therefore, they wouldn't have diversified portfolios. You wouldn't be able to spread the risk across all markets. It would just be too dangerous to trade, meaning that nobody would trade. So you have to be very, very careful. And remember, margin as well, it's just the amount you have to put down. So if you put down 1,000, if your brokerage was offering you 100 to 1, then you would have access to $100,000. So these are sort of a list of the margin, and basically it's sort of standard around most brokerages, the amount of margin required in percentage figures, in a ratio as well, the maximum. So guys, there are different types of margin. So I just want to go through this very quickly because we didn't go through it on the lesson. So firstly, there's required margin. The amount of money you have to give as a deposit to trade. Straightforward enough. Then your account margin, which guys is all of the money that you have in your account. Absolutely everything. Then usable margin. This is where all the money you have in your trading account. Absolutely everything. And then you have margin calls. So guys, this is very, very worrying, but it's something that we do bring up in the lessons, but it is certainly not something to worry about because this will never ever happen with correct risk management and the proper training. But we do have to make sure you are aware of it. So it's a fail-safe essentially. We'll close all of your open positions if the value drops below what you gave as margin. So let's say if you put down the $1,000 again. If 90% of that was breached and all your open trades would be closed immediately. So you have to be careful. And then finally, guys, is used margins. The amount of money that's already involved in the other trades. Now, obviously, it cannot be used in order to take out another trade unless you are profit protecting, ladies and gentlemen, okay? So, guys, I hope that was beneficial for you. I look forward to seeing you all now on the next lesson coming up very, very shortly. And, guys, make sure to spread the word. Remember, any family members and friends that you know that want to do a free Shaw Academy course, all they have to do is share our link that we send out mid-lesson, and therefore you will be able to give them the gift of learning completely free of charge. So guys, looking forward to seeing you now for lesson 3 coming up very, very shortly. Thank you very much.